Hey there guys, Todd here, welcome back. I want to do a video on one of the positions we put on today. That's the gold market. We put a lot of trades on today. We're pretty well positioned on the short side right now. There's a ton of volatility. Quite an interesting macro market here, a lot of macro forces at work. Watch Apple. I just did a video for CNBC. Apple breaks below 96. That's no bueno. Ready to get down to 81. So we're starting to move towards the defensive side, and this gold trade's been set up for some time, and I want to share it with you guys here on the free video. So this is the weekly GLD chart, and you can see that we've dropped in a nice 5-wave sequence. So there's wave 1, back up in 2, beautiful drop in wave 3, and you see that kind of continuation gap, which is very common in third waves. Then we go into a textbook fourth wave triangle. Usually when you see a triangle, it's in the fourth wave, so it's just textbook A, B, C, D, E, 5-wave triangle, done. Then this is when things get interesting. Wave 5 looks to be tracing out an ending diagonal, okay? They don't always happen, but when they do, they yield explosive moves. Basically, what ending diagonals are is they're falling wedges, okay? If you connect the trend lines on the highs, connect the lows, those two trend lines would touch. So it's kind of a converging pattern, and it's indicating that that sellers are getting tired. The trade has gone too far, too fast. The trade is crowded. Shorts are getting nervous. They're ready to eject, cover, and rip the market higher. So it look like that is happening. And then, if you think about it, everything that's going on in the macro point of view, China's falling apart, commodities are in big trouble, the Fed is probably not going to hike in January, so that's going to take some of the shine off the US dollar. The dollar uptrend's already been lost, so for all those things, the time is now for gold to go. So we put the trade to work, and I'll show you what it is. But first, we dive in here. On top of that, we do have Fibonacci confirmation. If you do waves 1 through 3, multiply it by 0.382, projected down from 4. That's a pretty textbook stopping point for wave 5. Okay, pretty good fib there. So let's go down from the weekly, go down to the daily, and get a closer look at this ending diagonal. So it's wave 1, it's 2, 3, 4, 5. Now on top of that, there's one more fib study which is pretty cool that I wanted to show you. We'll do distances of wave 3, multiplied by our fib, projected down from 4. And, how you doing? The 0.618 projection of wave 3 compared to 5 was the low. So 0.618 on top of that 38%, right over here off to the side from that higher weekly calculation, that was the low in gold, okay? So I think what's going to happen, guys, is we are going to squeeze higher in the gold market. So we put on an option position today that's going to take advantage of that. We structured it in a way that if we were wrong and this ending diagonal is not about to take hold and we're going to continue lower, we are also going to make money, okay? The problem is if we stay kind of range bound here, that's when we get hurt. So the trade that we put on was we did a call back spread, okay? So what we did, let me just show it to you. I did a 105, 110. So I sold the 105s, bought the 110 calls twice as many times. Okay, I just have a half position on right now. So sold the 105 calls right here. Sold 105s right about there. And then I bought the 110s, which are right about here. Okay, so that's fine. All right, so the trade actually, and I have it laid out in the P&L graph here, the trade gets hurt at 110, which is your long calls, okay? So the trade is the worst right here at 110, okay? So the green lines which you're focusing here on toss, okay? So 110 is that's the worst situation for this trade. If I'm right, we will lose money on the 105, 110 call credit spread, okay, because we have 2 contracts short at the 105, 2 contracts long at the 110. That's a call credit spread. That's a bearish trade, but we have 2 extra uncovered calls. So once the loss of the call credit spread is made up for, we have 2 uncovered calls that will kick into profitability right at this red hash right here at 114. So 114, guys, look at where that matches up. Right at this old high here, which was the wave 4 high. So if we get above 114, that's when the trade kicks into profitability, and an ending diagonal should carry way past 114. So that's the upside. The downside, this is interesting. If I'm wrong and GLD gets below $106, you'll see the green line is just above the profitability mark, which means we still make money. We still make a small credit. So if we break back below 106, which is right here, if we get back below 106 and continue lower, I still make money in this trade. It's where we get hurt is right at the 110. These are February monthlies. The chances of gold being right here with everything that's going on, I don't think so. So I think it's a pretty good bet. It's a good trade. I think it's a good way to trade Elliott in an ending diagonal, which can yield very explosive moves to the top side. But if you're wrong, you can still make money if it keeps going down. Those of you guys remember the GMCR trade, the Green Mountain Coffee trade, this was a very similar setup. We were lucky enough to step into a buyout there, and we made over 3,000% return on our options, and we had that trade on live, so that was good. It's a similar setup. Okay, so we'll leave it there, guys. Hope that video helped, and we will catch you on the next video update. See you guys.